When it comes to immigration, it's always important to know what specific tax applications might come with your situation and what actions you may need to take to get your tax affairs in order. As the only English-speaking country in Europe after Brexit, along with one of the best education systems in the world, Ireland has become an attractive immigration country for Hong Kong families in recent years. Today we have Gabriel Ho, Directors of People Services from KPMG, to share with us their insights on tax-related considerations and suggestions before moving to Ireland.
Thanks for having me, Jay.
In the previous episode, we talked about the major types of Irish tax. Gabriel, writing on the tax topic, do you have any tips for people who want to move to Ireland?
So the tax regime in Ireland and most overseas jurisdictions is fairly different from our tax regime in Hong Kong. Individuals who are considering moving to Ireland should understand the tax implications and plan ahead. So in a nutshell, an individual's Ireland tax position largely depends on their tax resident status for that year. A tax resident may be taxed on their Ireland-sourced income and foreign income. The tax base and types of income subject to tax in Ireland is much wider than the tax base in Hong Kong. For example, personal investment income and capital gains on the disposal of assets may be subject to Ireland tax. The tax rates in Ireland and most jurisdictions in Europe are generally higher than the rates in Hong Kong. Currently, the Ireland income tax rates are up to 40%. Capital gains are taxed at 33%.
So it sounds like taxes can be expensive under certain circumstances. Our clients always ask, is there any way to minimize the tax liability, of course legally? Any suggestions on that?
Yes, and in general, there are opportunities to plan. The key is to plan ahead and well ahead before you move to Ireland. So I suggest that they, as a starting point, may consider the amount of time they anticipate to spend in Ireland and plan their finances before they move to Ireland. This can significantly impact their Ireland tax position and tax liabilities. So broadly, an individual is tax resident in Ireland if they spend 183 days or more in Ireland during the tax year, or spend 280 days or more in Ireland in total across 2 consecutive tax years. If they are a resident, they may be subject to tax in Ireland on their foreign income and gains. I suggest they consider the residency requirements under different immigration programs and the potential impact to their Ireland tax resident status and position.
Ireland's Immigration Investor Program IIP is suitable for high net worth clients because they are only required to stay 1 day per year. But what about those who are planning to stay in Ireland for more than 183 days? Do you have any tips for them?
So this can get quite complex, and I suggest they take advice and plan ahead. Maybe let me share a few ideas at a high level on planning. They may wish to review and consider whether they would like to sell assets before they move to Ireland and become tax resident in Ireland. This should mitigate capital gains tax in Ireland. The tax year in Ireland is from January to December. In general, if they would like to dispose assets before they move, we suggest they do so at least 1 year prior to becoming a tax resident in Ireland. The gain should not be subject to Ireland tax even if they remit the proceeds to Ireland at a later time. For example, if an individual who will move to and become tax resident in Ireland in 2022 disposes assets on or before 31st of December 2021, the gain should not be subject to Ireland tax even if they remit the proceeds to the Ireland bank account in 2021 or later. If they receive foreign income or dispose foreign assets after they move to Ireland, the income or gain may still be non-taxable in Ireland. Broadly, this is provided that they are non-Ireland domiciled and they do not remit the funds to Ireland in a year that they are resident. They should plan ahead, consider whether and when they may need to remit the funds to Ireland. If they may be non-resident in a subsequent year and can wait until that year to remit the funds to Ireland, it may be possible to remit the funds to Ireland tax-free.
So this treatment of foreign income and gains being non-taxable if the funds are not remitted to Ireland is very interesting. Any other tips for our clients?
Yeah, the remittance basis of tax on capital gains generally applies to gains on the sale of vanilla investments such as equities and government bonds. This does not generally apply to gains from the sale of all types of investments. So I suggest that they review and consider the treatment for each investment that they hold. Another suggestion I have is individuals may consider having separate bank accounts in Ireland. So, for example, one account for holding funds remitted to Ireland, which should not be subject to tax, and another account for holding funds remitted to Ireland, which may be subject to tax. This should help ring-fence income and gains, which should not be subject to Ireland tax.
So clients are also interested in inheritance tax. Could you explain a bit more about it for children inheriting in Ireland?
So in general, there's a capital acquisition tax that's charged on gifts and inheritances at 33%. This is a fairly complex area, and the tax treatment depends on a number of factors, such as whether the person giving the benefit or the person receiving it are resident. There are circumstances where a gift or inheritance may be fully or partially exempt from capital acquisition tax. I suggest that they seek advice on this from an advisor.
That's very helpful. Thank you so much, Gabriel and KPMG, for sharing all the information with us. Thank you so much.
No problem, Jay. Thanks for having me.